about to dive into Meta's latest earnings report, and trust me, there's a real mystery at the center of it. The main numbers, well, they just don't seem to add up. So our job today is to figure out what's really going on behind the scenes. Let's get into it.
Just look at this number, negative 83%. Let that sink in for a second. That is how much Meta's profit dropped in the last quarter compared to the year before. I mean, a drop that steep for a company this massive, it looks catastrophic. It's the kind of number that would make you think the whole business is falling apart. But is that the whole story?
And right here, this is our central puzzle. This is where things get weird. On one hand, you've got revenue. That's the money coming in the door, and it's absolutely soaring, up an incredible 26%. But then you look at profit, what's actually left over, and it's collapsed by 83%. So how on earth does that happen? How can sales be booming while your profits are just getting crushed? This is the mystery we need to solve.
Okay, so to solve this, we need to find some evidence. And, in the world of finance, the number one place you look, the crime scene, if you will, is always the income statement. It tells the story, line by line, of how a company gets from all its sales all the way down to its final profit. So let's start digging for some clues.
Here we are, a simplified look at Meta's income statement. The best way to think of this is like a waterfall, right? We start way up at the top with all the money that came in, and as we move down, we subtract all the different costs, and whatever's left at the bottom, that's the profit. Our mystery is hiding somewhere in this cascade.
Our first clue is right at the very top. Revenue is looking incredibly strong. It's up 26% to more than $51 billion. And this wasn't just a fluke. They sold more ads and they charged more for them. So this tells us that the core business, selling ads on Facebook and Instagram, is absolutely firing on all cylinders. The problem is not a lack of sales.
Okay, let's move a little further down the waterfall. After we take out all the normal costs of running the business, research, marketing, all that stuff, we get to what's called income from operations. And look at that. It's up 18%. So wait a minute. Not only is the business selling more, it's actually making more profit from those sales than it did last year. The puzzle just got a little deeper. The problem isn't in the day-to-day operations.
So, we've narrowed our search. The problem has to be somewhere between that operating income number and the final net income at the bottom. And this visual right here shows exactly where the story takes a massive turn. Just look at that highlighted line, provision for income taxes. Last year, it was about $2 billion. This year, almost $19 billion. We have found our culprit.
So what in the world is this gigantic tax number? You're probably thinking this means Meta had to write some unbelievable check to the government, right? That it's crippling their finances. But, that's not really what happened. The truth behind this number actually shows us the company's real financial health. And it's a lot stronger than that headline number would have you believe.
Here's the smoking gun. It was a one-time, non-cash tax charge of nearly $16 billion. Now, non-cash are the two most important words here. Think about it like this. If an appraiser says the value of your house went down on paper, your net worth technically decreases, but no actual cash left your wallet, right? This is basically an accounting adjustment. It hits the official profit number for this one quarter, but it doesn't mean the company's bank account actually got any smaller. And this is our aha moment. This is the big reveal. The headline story, the one that was screaming about an 83% profit drop, showed earnings per share of just $1.05. But if we adjust for that one-off, non-cash thing, the real story is earnings of $7.25. I mean, that is a completely different picture of how profitable this company actually is.
And hey, you don't even have to take my word for it. Meta spelled it out for everyone right there in their earnings release. They literally say that without this accounting charge, their net income would have been a very, very healthy $18.6 billion. So the bottom line is, the underlying business is not collapsing at all. It's actually thriving. Okay, so we've solved the profit mystery. But now let's look at something that's maybe even more important for understanding a company's real strength, its ability to fund its own growth. This is where we stop looking at the accounting and we just follow the actual cash. Because cash tells you everything about a company's raw power. And to do that, we use this really powerful idea called the self-sustainable growth rate, or SSGR. Basically, it's a way to measure how fast a company can grow using only the cash it generates itself. No borrowing money, no selling more stock. A high SSGR is pretty much the ultimate sign of a strong, resilient business. It means the company is in total control of its own destiny.
So how much fuel is Meta's engine actually producing? Well, in just this one quarter, it generated $30 billion in cash from its operations. And remember, this isn't some abstract accounting number. This is cold, hard cash flowing into the company's bank accounts. This is the raw material they use for everything, for growth, for new investments, and for returning money to shareholders.
So what did they do with that $30 billion in cash? Well, this chart breaks it down perfectly. They spent over $19 billion reinvesting right back into the business, building new data centers, all that AI infrastructure. Then they returned about $4.5 billion to shareholders. And here's the kicker. Even after all of that spending, they still had over $6 billion left over, which they just added to their huge pile of cash. They funded everything they needed to do, and they still had billions to spare.
And that really is the bottom line here when we talk about the company's fundamental strength. Meta is a self-funding machine. Its main business creates this absolute tidal wave of cash, way more than enough to pay for its massive AI ambitions and keep all its shareholders happy at the same time. This is the definition of a powerful, sustainable financial model.
So far, we've pretty much been analyzing the past, what happened last quarter. But earnings reports also give us some really juicy clues about the future. You have to listen to what management says, what they guide for. That's where they tell us where the ship is heading next. So let's see what they're signaling.
Okay, here are the key signals. First, they expect revenue to keep growing strong into the next quarter. But look at the spending. They're raising their spending plans for 2025. And then for 2026, listen to the language they're using. Notably larger growth in capital spending and significantly faster growth in overall expenses. What they're telling us is, get ready, we are about to spend a lot.
So why the huge spending surge? Well, they were really clear about this. It's a massive, aggressive investment in infrastructure. We're talking data centers, servers, all the computing power they'll need for the next generation of AI. They are placing a gigantic bet that AI is the future engine of their growth, and they are building the factory to make it happen right now.
Of course, it's not all sunshine and roses. Management was also pretty upfront about a couple of major risks on the horizon. Over in Europe, new rules about personalized ads could really hurt their revenue. And back in the US, there are a number of trials related to youth safety that, in their own words, could result in a material loss. So these are definitely serious headwinds to keep an eye out.
So we've cracked the case of Meta's confusing earnings. But the real goal here is to give you a framework you can use again and again. So let's just boil down all of our detected work into a simple toolkit that you can apply to any company's report.
Here it is, just 5 simple steps. 1. Always question the headline. Look for numbers that just don't seem to make sense together. 2. Hunt down and isolate any of those one-off items that can distort the real picture. 3. Always follow the cash. It tells you the truth about the health of the business. 4. Read the guidance to see where management thinks the company is going. And 5. Make a note of the key risks that they themselves are worried about. If you do this, you go from just being a passive reader to an active analyst.
And all of this leaves us with the big, multi-billion-dollar question, doesn't it? We've seen that Meta's core business is a cash-generating fortress, so strong it can fund this massive pivot. They are betting tens of billions of real dollars today on the belief that an AI-powered future is going to pay off big time tomorrow. Is this a visionary move that's going to define the next decade of tech, or is it just a hugely expensive gamble? Well, that's the story we'll all be watching. Thanks for tuning in.